on board, then Peter Cardillo, and find out what he's making of the globe right now. Peter, hi, good morning. Great to have you on the show. And I guess, Peter, all the focus is now Far East to Japan with the new PM-elect and the way markets are receiving her.
Yes, indeed. And of course, you know, it caused their currency to take a pretty steep dive, and again, that is against the dollar. And that ignited a very powerful rally in the Japanese stock market. And it'll probably continue for another day or two. And so, you know, it looks as though there's a good possibility that stimulus will be cut back, and the possibility of a rate cut is on its way. And so the Japanese stock market applauded the election of the first female ever prime minister.
Okay. Peter, I wonder how you're looking at the move in gold. It just, every time one feels that we've made a sort of top, we continue to breach higher highs. So talk to us about where you're seeing that trend play out. There are, of course, now talks of $5,000 an ounce on gold. How realistic is that, in your opinion? Give us that take.
I think it's very real. In fact, my near-term target is 4150, and so after that, I think, you know, it could level off for a while, but I think eventually we're going to 5,000. All the ingredients for the gold market to continue to rise are in place, and it was long coming. And you know, from a fundamentals perspective, central banks continue to be big buyers, and this is a key point. But of course, you know, there are so many ifs and uncertainties, and of course, with the stock markets continuing to reach new highs, the gold market is a good place to bet your hedges. And so I think, you know, we'll just continue in the short term to move higher.
Okay. And Peter, how should one look at bond yields as well? Because they've been very, very range bound, but at the same time, the outlook by the Fed is quite different from what it was maybe 4 or 5 months ago, where they were really holding out. They've relented to a certain extent. Give us the sense on how risk reward is playing out in equity markets versus bond yields, and what you make of the bond yield of around 4.1% on the 10-year US.
Yeah, well, it's been up one or 2 days, and I think, you know, the reason for that is this week. In fact, beginning today, we have the 3-year auction, and then followed by the 10-year, and then, of course, the 30-year. And I think the market is positioning itself for those bond auctions, and I don't see a very strong demand. And the reason why I say that is because, again, you know, the possibilities of the Fed still holding off before becoming aggressive in terms of cutting interest rates is very real. And that's because of the sticky high inflation that we have. And of course, it's in direct contradiction of what the president administration would want. And so the fact that you have a crowded bond market, that means you're going to see demand not all that's strong. And of course, again, it revolves around the uncertainties. We still have tariffs to deal with. We still have major trading partners that have to sign trade deals. And, of course, the big one is China and India as well. And so there are a lot of uncertainties out there. Now, one could make the case that the government shutdown, if it were to linger, let's say, over 2 or 3 weeks, then there's a good possibility that, the Fed could become more aggressive and actually cut by 50 basis points. But that's yet to be seen. And in fact, there's no question that a prolonged shutdown will bite into GDP.
Oh, absolutely. Peter, so good having you on the show today. Thanks for your time.
Thank you.